You've saved for years, you're finally retired, and now you're staring down one of the biggest tax decisions of your life. Should you convert part of your IRA to a Roth? It feels risky. You're paying real money in taxes now for a benefit you might see decades down the line. Well, that's exactly what James and Jessica wrestled with. They've got a 7-figure IRA, no debt, and a clear goal. Don't make a mistake they'll regret at 85. This video walks through their plan and gives you a simple framework to decide whether a Roth conversion makes sense for you so you can make a wise decision with clarity and confidence. Now, before you decide whether a Roth conversion makes sense, you need to understand the one reason it's even worth considering. What makes this decision urgent, and what's the real upside? Let me start with a bit of a warning. A retiree I met recently is in her late 70s. She did a fantastic job of saving, but now her required IRA withdrawals are twice what she actually spends. Every December, her custodian dumps a giant distribution in her checking account, and every April, she sends a chunk of it right back to the IRS. She told me she wishes that she dealt with the tax side long before it snowballed. The story highlights 4 realities we really can't ignore. First, retirement moves you into a brand new tax world that often hides advantages in plain sight. And second, those advantages only help if we spot them before new income sources switch on. Third, when Social Security, RMDs, and rental proceeds arrive together, they crowd out the lowest tax brackets and erase that flexibility. And finally, Roths are often associated with legacies to children, but even if you don't have children, your future self or a surviving spouse can face far higher taxes than you expect. So instead of guessing, we laid out every dollar James and Jessica expect to earn or withdraw over the next 30 plus years. James's part-time wages end in 2026, 2 separate Social Security start dates, and required minimum distributions at age 75. Well, seeing that entire timeline on one page showed exactly when action would matter most. James and Jessica, they did the hard work of saving. They made responsible choices, avoided lifestyle inflation, and stayed invested. Well, this tax challenge isn't a penalty for bad planning. It's a result of actually doing things right and now needing to protect what they've built. The only real reason to do a Roth conversion is if you'll pay less in tax now than you or your spouse would later. So who's actually in position to benefit from this? Let's start with James and Jessica's plan. It may have some similarities to you. So let's picture their balance sheet. They have $2 million in IRAs and 401k, smaller Roths, a strong brokerage account, and then also a rental condo that brings in about $2,000 every month. They also have a small pension that will kick in later. They've paid off most of their debts except a low fixed rate mortgage. They do live modestly and they travel a few times a year to see family. Current income includes James' part-time wages, which gives them breathing room without pushing them too high up on the tax bracket ladder. They do spend wisely and they're very intentional. And it's that intentionality is what's made this planning worthwhile. So what they came to realize is that this very ordinary mix of accounts sets up a very specific tax problem. If they follow the default spend the brokerage account first path, their marginal rate jumps from 22% and then 24% and then actually up to 32% later in life. And that's not because of lifestyle creep, but because of how required distributions, pensions, and Social Security hit the return. So we modeled 2 futures. In the default, that spike arrives in the early 70s and it stays elevated. And we created a very targeted Roth conversion path, as I'll show you. We keep the top rate at 22%, and it's mostly even less than that, even with the same lifestyle, but far lower lifetime tax. That's what planning gives you, the chance to flatten the spike before it arrives. So timing is really everything. And for James and Jessica, updated tax laws and life circumstances created a unique but brief opportunity. So let's look at what made this window so valuable. Right now, they're in the 22% tax bracket. Back when they worked, they sat in the 24%. And in full retirement, at least for a few years, they'll actually drop lower. And that creates a narrow window to act. One thing we're paying attention to is Congress has passed the One Big Beautiful Bill Act, and 2 provisions really stand out that matter to us. First, the SALT deduction cap for state and local income taxes jumped to $40,000. Well, Californians like James and Jessica can finally itemize again, which makes every deductible dollar more meaningful. And then second, a new senior deduction up to $6,000 each. It kicks in at age 65, and then it starts phasing out once income tops $150,000 or $75,000 for your single filers. And that won't apply to them quite yet, but we're going to be watching it closely. Those extra deductions play in favor of the Roth conversions. Now, consider also where we're at historically. Top federal tax rates have exceeded as high as 90% in the past. Today's rates are some of the lowest in decades, and if you haven't seen, the national debt is at an all-time high, and many retirees don't want to bet on rates staying this low forever. So here's where it gets interesting. There's this hidden gap between retirement and RMDs that most retirees either they never notice or they take it as a windfall. And this is one of the most underutilized parts of a retirement plan. For a stretch of time, often 5 to 10 years, retirees like James and Jessica have little to no taxable income. That's because they're drawing from brokerage accounts or savings, which often include a return of their own capital and then long-term capital gains taxed at favorable rates. Well, in their case, from 2027 to 2039, their taxable income would sit almost entirely within the 10% tax bracket. On the surface, that feels like a win. But what it actually does is waste the low 10 and 12% brackets, and more importantly, fails to prevent the tax spike that hits once Social Security and RMDs start. This is the valley, not because they lack money, but because they have low reportable income. It's a hidden opportunity. So we want to use that valley, converting dollars early that would otherwise later be forced out at higher tax rates. This only works with clarity. That's why we projected their income year by year. The effective tax rate is low, but then jumped fast once RMD started. So filling that low period with Roth conversions can let them control what would otherwise be uncontrollable. So that time between retirement and RMDs, they faced over a decade of unusually low tax rates, that tax valley that made conversions especially appealing. So what happens if you skip that window? Let's talk about income stacking and how it can quietly wreck your future tax rate. Because most people think of retirement income as this gentle stream, but in reality, it's kind of a flood. Social Security turns on, RMDs start, and those investment dividends and rental income, they continue. Every new dollar risks pushing you into a higher tax bracket or higher Medicare premiums. James and Jessica, for example, they plan to sell their rental in 2026. So that year, even a modest Roth conversion will be a lot of taxes to stomach. So instead, we can delay conversions this year and next. And it's not just about whether to convert, it's about when. So by smoothing that curve over time, even modest conversions in low income years, they reduce the burden when income stacks later. And by capping conversions to the 12% bracket, we keep things simple, predictable, and within their comfort zone, as I'm going to show you. And even without kids, there's risk. Now, in James and Jessica's case, they don't have kids, so passing on Roth assets is not necessarily a priority for that. And you might think, well, why bother? But even without a legacy goal, there's one big risk most couples overlook. Taxes don't just affect you today, they affect your surviving spouse too. And once one partner passes, the survivor switches to a single filer status. That means narrower tax brackets and often higher effective tax rates, even with the exact same or slightly less income. So let's say James passes first. Jessica keeps receiving her pension, the higher of the two Social Securities, and required distributions from the IRA. But as a single filer, that 12% bracket ends sooner and then jumps to 22%, which hits much faster. It's an invisible penalty for being a widow, and unfortunately it shows up exactly when clarity and simplicity are needed the most. Roth conversions done now, while both spouses are alive and filing jointly, they help create breathing room later. And we're not talking about doubling their Roth right away, but small incremental moves now mean fewer RMDs and less taxable income for their surviving spouse later on. Now, all this may sound good, but what did the math actually show? Let's look at their real-life plan to see how it played out. We ran side-by-side projections, one where they follow the default path and then eventually get to those required distributions, and then side-by-side, the other where we convert strategically during that tax valley. So what's interesting is a full conversion plan where it's optimized actually showed them converting all the way up to IRMA bracket 3. That would save them an estimated $1.1 million in taxes, present day dollars over their lifetime, based on current rates and expected longevity, and that's substantial. But it also meant writing big tax checks in the early years of retirement. The math may be right, but the emotional hurdle is real. James and Jessica, like most people, weren't ready to go quite that far. So we looked at what could still make a significant difference and give them more flexibility. In this case, converting up to the 12% bracket, well, this could help avoid triggering higher Medicare premiums in the future and still carve out a lifetime estimated savings of $863,000. Still a very good result with far less upfront risk. Now, these are just estimates far out into the future, but the key is flexibility. Towards the end of each year, we can look at income, then we can convert the right amount, not based on a fixed schedule, but based on the numbers that are in front of us. It's a rhythm, and over time, that rhythm really does add up. So what should you take away from this? It's not about finding the perfect Roth strategy. It's about using the window that you've got. You want to focus on being intentional. Roth conversions don't have to be all or nothing. Even small, well-timed moves can shift your entire tax landscape. The goal in itself isn't to maximize the Roth. The goal is actually to reduce future regret and preserve flexibility and control. Every year is a new chapter. Income changes, laws evolve, life happens. That's why we update the plan every year. Sometimes we convert more, sometimes we pause. The power isn't in the spreadsheet, it's in the freedom to adjust. And this applies whether you're retiring today or already a few years in. In fact, I just spoke with someone else who was close to 80. They'd built up a large IRA, far more than they needed, and their RMDs now push them into a higher bracket each year. They were just trying to reduce taxable income, and they were frustrated that the window for action had passed. For James and Jessica, they didn't want to be in that position. That's why they're acting on this plan. They don't need to do everything, but just do enough. So in this video, I showed you how James and Jessica's smart, well-timed Roth conversions could potentially save them over $860,000 in taxes. But what if you're one of the many retirees who could actually lose money by converting? Watch this video next, where we break down 9 real scenarios where a Roth conversion can actually backfire, and how to avoid that mistake that could cost you tens of thousands of dollars. If you'd like help with your retirement plan, I've dropped a link in the description to schedule a short call. Thanks for watching.